Good afternoon, all. I'm Howard Clark Burton, CEO and founding director of BMP Wealth here in Hong Kong. Just by way of introduction, we are a wealth management firm based in Hong Kong. All our operations are here in Hong Kong, and we specialize in giving advice to internationally minded people who have got cross-border issues or moving around the world in multiple facets of the financial world. In a nutshell, what that really involves is making sure and working with people that they have enough money to last the rest of their lives and in the lifestyle that they want to live. That's what we focus on. Now, today, we're looking at people who want to move to the UK and some of the financial planning aspects around that, just from a very broad perspective. And we've got some case studies at the end, which is very enlightening. So please hang on towards the last 20 minutes when we go through those. But a bit of housekeeping, please ask questions as you go by using the chat button at the bottom, or you can save them at the end. There'll be space for some question and answers at the end if you wish. Which should be approximately 1 hour or slightly less if there's less questions. And we will be circulating copies of this video and anything and all the materials afterwards for everybody who's been attending. Now, so on that note, what I'd like to do is hand over to Jason Pierce, who'll be running through the initial parts. Now, we had some technology issues earlier, so we just have to share the screen. So I'll sit out while Jason will come in. Over to Jason.
Thanks, Howard. Good afternoon, everybody. So I'm going to take you through an introduction to UK taxes for people that are not necessarily familiar with them. So there we go. Okay, so just by way of introduction, sorry, just there we are. So just click there. Yeah, so when you see something on the slide that's in green and underlined and in bold, it means that it has a legal or a technical term, and the meaning might be slightly different to its normal everyday English meaning. I'll show you an example on the next slide. For currency conversion purposes, I'm just doing 10 Hong Kong dollars to the pound. And then some acronyms, firstly HMRC, which is the UK's version of the IRD, Her Majesty's Revenue and Customs, capital gains tax, which obviously we don't have in the UK, but we very much do we don't have it in Hong Kong, but we very much do in the UK, and then inheritance tax, same thing for that as well. So I'll be alluding to those as we go through. So firstly then, what is UK residence? Well, for comparison purposes, in Hong Kong, it's a very simple day count. You simply need to spend either 180 days of the year here or 300 days over a 2-year period, and that will make you Hong Kong resident. So very, very simple, simple matter of counting days. For the UK residents, by which I mean tax residents, the first thing to note is that the tax year is slightly different. It runs from the 6th of April to the following 5th. That's for historical reasons going all the way back to Julius Caesar, but we haven't got time to cover that today. So, and then residence depends upon the number of days that you spend in the UK. So it is a day count. Now you'll see there that the word days is in green and bold and underlined. That means that has a technical meaning for the purposes of UK tax resident. And what it actually means is being physically present there at midnight. So if you're in the UK at midnight, you are technically there for that day or the day leading up to midnight. So if you take a flight to the UK and it arrives at 5 to midnight, that's 1 day of residence because you're there at midnight. But if it arrives at 5 minutes past midnight, that is not a day of residence. The following day is, of course, but that's where the distinction is. So if you are in the UK, meaning if you're there at midnight for 15 or fewer days of the tax year, you are categorically not UK tax resident. So anyone can spend up to 15 days of the year of the tax year in the UK between April and April without becoming tax resident. At the other end of the scale, if you're there for 183 or more days, you are categorically tax resident, and that means you're resident for the whole of the tax year, which could mean that if you go there in September, October, your tax residence will actually be backdated to the previous April. So there are some potential traps there to avoid. Now, what happens if you're there for more than 15 but fewer than 183? If that's the case, you need to take the statutory residence test. So this was introduced in 2013 in the UK. This is a flow chart that my company has produced. There are many available. All of the accountancy firms produce these. It's basically a one-pager where you go through, answer a series of questions, and it will tell you how many days you can spend in the UK for your particular circumstances if you want to avoid becoming tax resident. Or it'll just tell you if you spend this number of days there, you will be. So you just go through and answer the questions. You come to the bottom here, and if you're moving to the UK, it's the section on the right hand side here. So if you're moving to the UK and you haven't been in the tax resident for the previous 3 tax years, you can actually spend up to 45 days in the UK and not be tax resident there. Obviously, they're under the scale 183 or more. Everyone is tax resident in that. But if you're somewhere in between, it will either be up to 90 days, 120, or 182 days. And this depends upon what we call your ties. So ties to the UK are things like, do you have a home there? Do you have a job there? Do you have family there? And so on. So for each individual tax year, if you're there for fewer than 183 days, you'll need to take the statutory residence test to determine whether or not you're tax resident, and that will affect your tax position, obviously. So you could be there in the worst case scenario for only 46 days, but be tax resident for the whole of the year. So that means that you could move to the UK at any time before the 19th of February of this year and actually end up being tax resident going all the way back to April of 2020. So it means that you could actually be UK tax resident right now, even though you're physically here in Hong Kong. So for that reason, it's always better to arrange your financial affairs in the tax year before the one in which you intend to move. So if you intend moving to the UK before the 5th of April of this year, it's kind of too late in some cases. You can still do some planning, but you'll be restricted. So it's better to do your planning now, then move to the UK after the 6th of April of this year, and then it'll be a clean break and your situation will be a lot better. So that's UK residence. It's a simple matter of day counts, but in the UK, we also have a concept called domicile. Now, we don't have domicile in Hong Kong. The vast majority of countries in the world don't have domiciles. So what does it actually mean? Residency is straightforward. It can be complicated, but it just boils down to a day count test. Domicile, or DOM for short, it's an entirely different legal construct. So it's also different to permanent residency, it's different to citizenship, it's different to nationality. All of these things are different in UK law. Very broadly, because there is no single definition of domicile, it's very broadly the country that you regard as your permanent home, or the one with which you have the most substantial connections or ties. So when you were born, you inherit the domicile of your father if your parents are married. When you're born, or if your parents weren't married when you were born, you would have inherited your mother's domicile. Now this is a real life example. It's a friend of mine. Dimitri was born in London. His father was Russian and his mother was English. They weren't married, but they were living together in a long-term relationship. So he grew up in the UK. He then moved to Hong Kong, which is where I met him. He worked here for quite a few years, and then he moved to Australia. So he has Russian nationality from his father, and he's got a Russian passport, but he inherits the domicile of his mother because his parents weren't married, so he's got UK domicile. He also has permanent residency in Hong Kong, although he's not physically here, but he does come back to make sure he keeps that, and he's actually resident in Australia. So he has connections with 4 different countries all at the same time. So this just demonstrates, and as I say, Dimitri is a real person, that his nationality and his domicile and his residency are 3 different countries. So for UK tax purposes, everyone has a domicile. But if you've never had any connection with the UK and never will have a connection, it's clearly irrelevant. But if you're watching this presentation, I'm assuming that you're thinking of moving to the UK, so it will be relevant. If you've ever lived there before, if you were born there, or one of your parents was born there, or if you own property there, then it is relevant. Okay. You can only have one domicile at a time, so you can't be domiciled both in Hong Kong and in the UK, but it can be changed. Okay, so if you're a Hong Kong person, you move into the UK, you won't initially have a UK domicile. You'll keep your Hong Kong domicile for a period, but it can easily change to be domiciled in the UK. Now, if you are a UK resident, but still non-domiciled, called a non-dom, there are some tax advantages for you while you're still a non-domicile. Okay, so let's then have a look at UK taxes. So the first thing to say is that the UK and the Hong Kong tax systems are very different. In Hong Kong, as you're well aware, the taxes are quite straightforward and comparatively low. The Hong Kong tax code is only 276 pages long. It's very, very simple. The Australian one, just for comparison purposes, 6,000 pages long, and taxes there are higher as well. The UK, though, the last time anyone counted, it was 17,000 pages long. That was 6 years ago. It's probably more like 20,000 pages by now because it gets longer every year. So it's 10 million words. For comparison, it's 12 times as long as the Bible. Okay, and that's what the tax code looks like. Okay, now there are also different systems of personal taxation in the world. So there are some countries where they don't have income tax at all. So most famously Dubai and a few other countries as well. So if you move to Dubai, you don't need to worry about income tax. They have other taxes there, of course, like purchase tax and so on, but there's no income tax. Secondly, you have territorial tax. So this is where you're only taxed on the income that arises in the territory where you're living. So that's the way that we do it here in Hong Kong and in Singapore and Malaysia. But if you look at that map in the light blue, it's very unusual. The vast majority of the world is in dark blue, which is residence-based taxation. And that's where if you're resident in the country, you're subject to tax on your worldwide income and gains. So the UK, Australia, most of the rest of the world. There's a fourth one, which is probably the most, is probably the kind of worst of all for some people, which is it's citizenship based, most famously America. So if you're a US person, it doesn't matter where you live in the world, you have to pay taxes back in America. Okay, so when are UK taxes payable then? So the first line is non-UK resident, non-UK domicile. So this is somebody that's living in Hong Kong and is not a UK domicile. So, but if you have income or capital gains in the UK, because they are in the UK, they are subject to tax there. Obviously, though, your non-UK income and gains are not taxed. Most people, if they have UK income that comes from investment property, so that's subject to income tax. It's also subject to capital gains tax. So if you own property in the UK and you sell it for a profit, that's taxed. It never used to be taxed, but the law was changed in 2015 to bring even overseas people into the tax world of capital gains tax. So if you own a property in the UK and you sell it and you're still living in Hong Kong, you will have to pay capital gains tax on the gain and the value of the property since 2015. It's also subject to inheritance tax as well. Now, Hong Kong people used to be able to get around inheritance tax by owning their property through an offshore company, either a Hong Kong company or a BVI company and so on. Again, another change in the law, this was in 2017. It doesn't matter what structure you use to own UK property now, whether it's a company or a trust or a foundation or any combination of those things, they will look through any offshore structures to find the actual human being that really owns the property. And when that person passes away, it will be subject to inheritance tax. So there's been over 20 changes to the taxation of UK property in the last 9 years, and there are more coming. The next one will be on the 1st of April. If you own other assets in the UK, so if you've got a UK bank account with sterling in it, that will also be subject to inheritance tax, even though you're not living in the UK, not domiciled there. It's the fact that it's actually in the UK, that's what brings it into the UK tax net. But while you're still non-domiciled, any non-UK assets, so your Hong Kong property, any other assets you own in Hong Kong, they will not be subject to UK inheritance tax while you're still non-domiciled. So you're a Hong Kong person, you're moving to the UK, and initially you'll keep your Hong Kong domicile. So you're UK resident, but non-domicile. So we're into the second line now. UK income and gains, obviously taxable, but your non-UK income and gains, so any gains or income in Hong Kong or anywhere else in the world, will not be subject to tax in the UK, even though you're living there, if you use the remittance basis. And I'll cover that in the next slide. UK investment property, always subject to tax, no matter where you're living, no matter where you're domiciled. Other UK assets as well, but while you're still non-domiciled, your non-UK assets, so your Hong Kong property, won't fall into the UK inheritance tax net. But at some point, if you stay long enough in the UK, and it's 15 out of 20 years, you will become UK domicile. It's what's called deemed domicile. It always used to be 17 out of 20 years, and then it was reduced again in 2017 down to 15 years. So once you're UK resident and UK domicile, you're subject to UK tax and inheritance tax on your worldwide assets. Okay, so the remittance basis then, this is the tax advantage for you for the first few years when you're in the UK. So you have the choice of two different methods of paying UK tax. The first is what's called the arising basis. And this is where you pay UK tax on your worldwide income and gains. So this will be for a UK resident, a British person born in the UK, brought up there, subject to worldwide tax. But if you're non-domiciled, you have the option of the remittance basis. This is not available to UK domicile, only to people that are moving to the UK. Now, obviously, you pay UK tax on UK income. And if you have any offshore income and gains, if you remit those to the UK, and I'll explain what a remittance is shortly, but basically, if you transfer any income or any gains into the UK, that brings it into the UK tax net, and that will also be subject to UK tax. But you don't have to pay UK tax on any income and gains that you keep outside of the UK. So if you own a property in Hong Kong and you're in the UK and you sell your Hong Kong property for a profit, but you leave that profit in Hong Kong and don't remit it to the UK, that will not be taxable while you're still a non-domicile. Okay, so you can choose which basis is the best for you for each individual year for up to 15 years after moving to the UK. The tax year ends on the 5th of April. You have until the following 31st of January to decide which of the two bases you want to be taxed under. So it gives you time to look at your tax affairs in the tax year that's ended and give you time to make your mind up. Now, you might think, why on earth would anyone choose the arising basis rather than the remittance basis if they've got the choice? Well, for the first 7 years, there's no charge to use the remittance basis, but from year 8 onwards, if you want to use the remittance basis instead of the arising basis, you have to pay for it. And the remittance basis charge starts at £30,000 a year. So depending upon the level of your non-UK income and gains, it may be cheaper for you to actually pay on the arising basis and save yourself £30,000 a year. From year 13 onwards, and for 3 years, it's £60,000 a year. So again, you need to make the decision, you know, is it going to cost me more to pay that than to pay income on my offshore income and gains? And then from the start of year 16 onwards, you will be deemed UK domicile and you won't have access to the remittance basis any longer. Basically, you've been in the UK so long, you're treated exactly the same as a UK resident national. Okay, so you can acquire a UK domicile in 3 different ways. But in doing so, obviously, it brings all of your worldwide assets into the UK tax net for all UK taxes: income tax, capital gains tax, and inheritance tax. So the first one, like I mentioned, is the 15 out of 20 years. That's being deemed a domicile. That's a simple, straightforward matter. It's a matter of fact whether you've been there 15 out of 20 years or not. The second one is called a domicile of choice. Now, this is broadly where you form an intention to settle permanently or indefinitely in the UK. So people that are moving to the UK, generally, they might have the intention, but they might decide within the first year or two that actually they're not going to settle there permanently. It might be that they don't like the weather, or they're just there for a period while their children are at school or university there, and so on. But if you do have the intention to settle there and spend the rest of your life there, then you will have acquired a domicile of choice. And that can happen far more quickly than 15 years. It could happen after as little as 2 years. Now, some people say, well, you know, an HMRC say that they have settled there and they dispute that. In the event of a dispute, it can only be settled by a court. And the UK courts have always been very, very busy with judging on domicile disputes between individual taxpayers and the taxman. The third method is to actually elect to be UK domicile. We'll cover that in a separate presentation. For most people moving to the UK, it'll be one of the first 2. Okay, now, if a domicile is going to happen to you, either because you've done your 14 years and you're approaching the 15th, or it is that you've settled there, if you think your domicile is going to become UK, you can do financial planning in advance, which will then save you many unnecessary taxes. The key, as always with these things, is to do for your financial planning in advance. So in terms of how the UK tax system actually works in practice then, well, first of all earnings and pensions in the UK are subject to tax. So if you're working in the UK, either employed or self-employed, there's also another form of tax on top in the UK called national insurance, which is as high as 12%. Unlike Hong Kong, any annuity income that you have or any pension income, that is fully subject to tax in the UK. All forms of income are taxed. and then rental income as well, which is like properties tax here in Hong Kong. Now, if you're living in Hong Kong, that's the only form of income tax that you need to be concerned with. If you're in the UK, it's very different. So all savings income in the UK is taxed as well. So any interest that you get from a bank account or any interest that you get from other forms of fixed income and fixed interest, those are taxed in the UK. Dividends are also taxed in the UK. Doesn't matter whether they're from a public company or a private company. And also if you have an equity income fund that pays dividends, that's fully subject to tax as well. Insurance policy gains, those are subject to income tax, even though they don't actually produce an income. They're a non-income producing asset. So they're subject to a special set of rules called the chargeable event rules, which are actually highly advantageous. And then on top of that as well, of course, there's capital gains, which is not a form of income, but gains on disposal of assets, either by selling them or giving them away or transferring them into a trust. They're added to your income to establish what rate of tax you will pay. So in the UK, you only need to, in Hong Kong, you only need to worry about level 1. If you're in the UK, you've got 4 other levels to be aware of. Okay, now in very, very simple terms, in terms of the level of income tax that you're going to pay, if you add together all of your UK income and any income that you remit to the UK from Hong Kong, it will fall into 3 bands, up to 50,000 sterling, 50 to 150, and then above 150. In terms of income tax, the rates are 20, 40, and 45. So you'll always pay 20% income tax on the first band, and then you'll move up through the bands and then pay some at 40 and maybe some at 45. Okay, so the lowest rate of income tax in the UK is higher than the highest rate in Hong Kong. Capital gains tax, if it's on residential property, those are the rates that you'll pay, either 18 or 28% on disposals of property. On other assets, things like shares or mutual funds or ETFs, it's either 10 or 20%. And that's what it is currently. But there was a report last summer, and this is from the Sunday Times, in August of last year, the government is planning to raise both capital gains tax and corporation tax. So the next UK budget is on the 3rd of March. It may be that capital gains tax rates are increased then, or it might happen next year, but everybody's expecting there to be an increase. So it will no longer be 10 or 20, it's going to be something higher. But in terms of the actual numbers, how much tax will you actually pay? Because you'll pay some at 20, some at 40, maybe some at 45 there. So depending upon your level of income in the UK, and again, this is all your UK income, all the income that you remit into the UK. I've just got some example numbers here. So that's the amount of tax that you will pay. So if your income is £1 million, you'll pay £435,000 in income tax. Okay, so you have an effective tax rate which amounts to that. So at the highest level there at $1 million, it'll never quite get to 45% because there'll always be some at 20 and some at 40, but it can get close to it. Okay, so the remittance basis then. So people say if I remit my income to the UK, it's going to be taxed. So I need to be very careful about how much I remit. So, but it's actually much more complicated than many people think. Okay, it doesn't just apply to the individual taxpayer, it applies to people and entities they're connected with, and I'll explain that in just a second. And there are several tax traps that people regularly fall into because they don't take advice, or they don't take the right advice when they're moving to the UK. A lot of bankers in Hong Kong don't understand it. Why would they, if they've never been to the UK, why would they understand UK tax? But it's very important your bankers are given very clear instructions about how to manage your accounts once you're resident in the UK. And there are some UK planning solutions, which Howard will cover later, which actually solve these problems, which means you don't need to be concerned with them. So what is a remittance then? Well, most obviously a transfer of money into the UK. So you transfer money from your Hong Kong bank account to your UK bank account. That's obviously a remittance. But it isn't just cash. If you buy an asset outside of the UK, in Hong Kong or anywhere else outside the UK, with Hong Kong income and gains, and then you physically bring that asset into the UK, that is treated as a remittance of cash and is taxable in the UK as income or as capital gains. Any asset worth more than £1,000 sterling that you buy outside the UK and physically bring into the UK is going to be taxable if you're using the remittance basis. The only exceptions are things you can wear. So clothing, footwear, jewelry, including watches, are exempted. only if it's for your personal use. So if it's a watch that you bought for yourself, that's okay. But if it's not for you, it's for someone else, that's not okay. That will also be a taxable remittance. So that's a thing that many people are unaware of. Physical objects can be taxed. Another common one is using your Hong Kong credit card in the UK to fund your lifestyle. So you're in the UK and you're just using your HSBC Hong Kong credit card to buy things. If you pay for the credit card bill here in Hong Kong with your Hong Kong income, that is a remittance into the UK for the amount of the credit card bill. That is taxable in the UK, even though no money has physically gone into the UK. It's the use of the card in the UK that makes it taxable there. Also, if you take out a mortgage with a Hong Kong bank to buy a UK house, and then you service that mortgage with your Hong Kong income, that is also a taxable remittance of those mortgage payments. And any other form of loan that you take from a Hong Kong bank, if you put up security for that loan, and that's Hong Kong income and gains, the amount of the security is taxable in the UK as a remittance. That's the same as taking money into the UK. Also, if you service that loan with Hong Kong income and gains, it will be taxed again. So if you take a loan from a Hong Kong bank to fund your lifestyle in the UK, you can end up paying tax twice on it. And again, something that many people are not aware of. So those are all remittances into the UK. Okay, but it's also services provided in the UK. So if you're living in the UK and your children are at a fee-paying school there, and you remit money to pay the school fees to the school, that's obviously a remittance. So many schools in the UK have got offshore bank accounts. So they'll say to you, oh, you're from Hong Kong, you've got our bank account with HSBC in Hong Kong, so have we. So instead of sending the money from HSBC Hong Kong to our UK bank account, why don't you send it from your Hong Kong bank account to our Hong Kong bank account? It doesn't even have to be in Hong Kong, it could be in Jersey or anywhere else as well. But that is a remittance into the UK for the value of those school fees, because there's a service being provided in the UK, that is the education of your children. So even though not a penny has gone into the UK, not $1, that is a taxable remittance, it's taxable in the UK. Also, any flight that either lands in the UK or takes off from the UK that you pay for with your Hong Kong income, that is taxable as a remittance to the UK, because that plane was in UK airspace at some point. So you imagine you're flying with you and your family, business class with Cathay to the UK. If you pay for that with your Hong Kong income, that's a taxable remittance because the plane has gone into the UK with you on it. So it's also any remittance for the benefit of what's called a relevant person. So that again, it's in green, it's bold, underlined, it's a technical term. What it means is not only you, but your partner, and you don't have to be either married or in a civil relationship, it's just someone that you live with. Any children of yours under the age of 18, so any remittance that's for their benefit, so for you, your boyfriend, girlfriend, or whatever, any children under 18, that's taxable. Also, unique in UK tax law, a remittance for any grandchild under the age of 18. So if you're living in the UK, your grandchildren are there, they're going to school there, and you remit money to pay for their education, that is taxable upon you because that's a service for the benefit of your grandchild under 18. It also applies to any company that you have any connection with. So you might have a Hong Kong company or a BVI company. That's in scope, and also any trust that you have any connection with as well. These are all relevant persons, and any remittance provided through any of those is also taxable. So it's very, very comprehensive. So in terms of the type of remittance to the UK, it will either be what's called clean capital, and I'll show an example of that in just a second. Clean capital is not taxed because it's clean capital. I'll explain that in just a second. If it's income though, it is taxed because all forms of income are taxed in the UK. And if it's a capital gain, then that will also be taxed because capital gains are taxed in the UK. Now, most commonly, of course, you'll have a bank account in Hong Kong. It will have a mixture in it of maybe all of those things, because maybe your salary has gone into it, maybe some interest has gone into it, maybe you sold some assets and the proceeds went into it as well. So it would be what's called a mixture. And if it's a mixture, that's also taxed in the UK, and I'll explain how in just a second. So clean capital. if you're not a UK resident and before you become UK tax resident, then everything you own is regarded as clean capital. But that changes as soon as you become UK resident. And this is absolutely crucial because remember, you could be a UK resident before you physically move there. You could be a UK resident as far back as last 6th of April. Clean capital from the moment your residence starts can only be cash. It cannot be any other type of asset, only cash and a particular type of cash. I'll explain that. All of your other assets are potentially taxable. And if you have a bank account that's got a mixture of capital and any sort of income, in other words, interest that's been added to it, that has arisen after you've become UK resident, that's what's called a mixed fund. Again, it's another technical term. So if you've got a mixed fund, because there's some income and capital gains in there as well as capital, it won't be clear. You can't unravel it. It won't be clear what the remittance is. So the UK applies what are called ordering rules, another technical term there. And I'll show you 2 examples. They're usually disadvantageous though, because basically they treat income as being remitted first, which will be taxed anywhere up to 45%, then capital gains taxed at 28%, and then capital goes last. So here's an example of how it works. Let's say we've got Eleanor, she's living here in Hong Kong, she's got an account with HSBC with 10 million Hong Kong in it. She's non-resident, so that's obviously clean capital, absolutely fine, no problem. Eleanor moves to the UK and a tax residency starts on the 6th of April 2020, and she decides to use the remittance basis rather than the arising basis. Okay. Now, a couple of weeks after she moves to the UK, her bank add interest to the account of £200,000. So that account has now got her original 10 million Hong Kong dollars in it, but some income has been added to it. The interest is income in the UK and it's taxable. That's called tainting the account. It's no longer a clean account, it's tainted because it's got a mixture of income and capital in it. It's all cash, but there's 2 types of cash in it which are mixed up together. It's tainted. Okay, so it's now a mixed fund. It's no longer clean capital because the interest was added to it after she became UK tax resident. Now, her bank in Hong Kong aren't aware of the consequences of this because it doesn't affect them. So there's her 10 million clean capital as it was. There's the bank with the 200,000 interest. They add that to the clean capital account. That then taints it. So it's now a mixed fund. It's all cash, but it's 2 types of cash mixed up together, and it can't be unmixed. The bank can't take the interest back. It's too late. It's already mixed up. So a couple of weeks later, Eleanor wants to remit some money from her fund into the UK, $500,000 Hong Kong dollars in this case. So she takes $500,000 out, remits that into the UK. How is that treated? Because it was clean capital, but it isn't now. So the ordering rules, this is how they work. They say that that $500,000 Hong Kong dollars, it's made up firstly of all of the interest first. So it's not done on a proportionate basis. They treat all the interest as going first, the whole 200,000, and then the other 300,000 is capital. So the whole 200,000, the interest is subject to UK income tax at either 20, 40 or 45%. Now, this was a very simple mistake that could have been avoided very, very easily. Let me show you how. So there's our clean capital account with 10 million in it. There's our interest. We don't add it to the clean capital account. We have a segregated, separate interest account, and we leave that interest in Hong Kong. We don't remit anything from the income account to the UK because it will be taxed if we do. What that does is that leaves us with the 10 million clean capital, and any amount up to the 10 million can then be remitted to the UK without any tax. So by the simple expedient of having a segregated account and keeping the clean capital without adding anything to it, we've kept the whole 10 million that can be remitted and paying unnecessary tax. Here's an example with how it works for capital gains tax. So Ellen also bought some shares on the Hong Kong Stock Exchange for a few years ago. They've grown in value. They've gone up nicely. So she decides she needs to remit some money to the UK. So she sells down some of her shares and remits the proceeds to the UK. So it's going to be subject to capital gains tax. How do the ordering rules work here? Okay. So there was the original capital that she bought the shares for. There's the capital gain on top, the growth in it. So it's 900,000. She sells down 600,000 of the 900,000 that it's worth and remits that 600,000 to the UK. So how do we treat that 600,000, leaving the 300,000 behind? Well, no surprise, the whole amount of the capital gain, the 400, is treated as being remitted first, and therefore is taxable in the UK at 10 or 20% before any clean capital. So of the 600, the whole 400 gain is treated as going before any clean capital there. So again, not advantageous. In terms of the value of the remittance, this is something that shocks an awful lot of people here. So after she becomes a UK resident, Eleanor she's still got friends, income and assets in Hong Kong. One of her friends in Hong Kong starts a company, and Eleanor decides to invest in it. So she transfers $1 million of her Hong Kong income and gains to the company. This has nothing to do with the UK. This is Hong Kong income investing in a Hong Kong company, so no UK tax to be concerned about at this point. Unfortunately, though, the company doesn't do very well. So she decides to sell her shareholding in the company, but she only receives 20,000 Hong Kong back because the company has gone down in value. So she thinks it's only 20,000 Hong Kong dollars. It's not very much. If I remit that to the UK, there won't be much tax on it. So she remits the £20,000 to the UK. Now, unfortunately, the UK rules dictate that we have to look through that 20,000 to see where that began life. That $20,000 began life as $1 million Hong Kong dollars of Eleanor's Hong Kong income. That's what has been remitted to the UK. The fact that it's gone through an investment and reduced in value doesn't affect that in the slightest. So the remittance amount, which is taxable, is not the 20,000. It's the original $1 million Hong Kong dollars that she earned in Hong Kong. So again, this is absolutely shocking. Even if it had dropped in value to $1, if she remitted that $1 to the UK, it would still be valued at $1 million Hong Kong dollars and be taxed at that level. Very shocking, I know. The most obvious thing people say is, well, how are people going to even know about this, all this money, all things that are going between Hong Kong and the UK? Well, they'll know because there's something called the Common Reporting Standard, which came in 2017. I'm just going to scoot through this and show you very quickly how it works. So here's Peggy. She's living in Hong Kong. Peggy happens to have a bank account in the UK, which pays her some small interest every year. So because she's living in one country and she owns a financial asset in another country, the Common Reporting Standard says that the bank in the UK has to inform the UK tax people, HMRC, of the interest on the account. It's actually a lot of detail. So that's the information that they will tell HMRC all about the account. HMRC will then transfer that information to the IRD in Hong Kong. Now, because Hong Kong has got territorial taxation, the IRD don't care about Peggy's bank account in the UK or any interest for it because they wouldn't seek to tax it anyway, but they still receive the information. Now, what happens if Peggy moves to the UK? This is very different because then she's subject to worldwide tax. Peggy still has got some financial accounts back in Hong Kong with banks, stockbrokers, insurance companies, and so on. They will all report all of their account information to the IRD. And again, it's all the same information, very, very detailed. The IRD will then tell HMRC about that information, and they will compare that with what Peggy has told them on a UK tax return. And if there's any discrepancies, they'll be asking questions of Peggy. So that's how they do it. HMRC in the UK has a computer system called Connect, which holds 22 billion lines of data. Now, this is one of these artificial intelligence things. It does machine learning, but it's got more data than the British Library. So their computer system is connected up to a lot of other systems. This is just the ones that they tell us about. It's connected to the land registry, and the land registry in the UK has got the details of the owner of every property in the UK and the owner of all land. They also look at the estate agency websites as well, so they can see any income that's being produced. They also get information from PayPal and those sort of websites, so they can see if someone's trading on Amazon. They're connected to all, of course, the other UK computers, so they even know what car you're driving from the driver licensing agency. They get all the information from the airlines, so they'll see all the flights that you're taking, where you're going to, what class you're flying, who else is flying with you. They also scrape data from all of the social media websites. So if you buy yourself something, take a photo and post it on social media, that will feed into them. And of course, they get all the credit cards purchase details as well. So an enormous amount of data growing exponentially all the time. The computer sifts through it and it looks for discrepancies. So if you tell them that your income is only £20,000 a year, but you're taking first class flights to the Caribbean, that's going to come up as a discrepancy and they will then start to investigate. They also receive data from Airbnb. This is from October, so Airbnb are reporting data to HMRC for people renting out their own properties. Now, there is a double tax treaty between the UK and Hong Kong, which is designed to stop you having to pay tax twice. So these are the taxes that it covers, all the personal taxes here. So in very general terms, if you've paid tax in Hong Kong on income, or well, you won't pay capital gain, but if you pay it on income, so property tax, then you'll get a credit for that in the UK. But if you've been paying 15% property tax in the UK and you remit the money to the UK and you're paying 40% tax in the UK, you will have to pay the other 25% on top in the UK. And if it's something that hasn't been taxed in Hong Kong, like a capital gain or interest or anything like that, that will be still taxed in the UK. Okay, I've scooted through that bit. I'm now going to hand back to Howard.
Hello all again. So the obvious question is, after seeing all of that, are you still going to move to the UK? What options do we have? And you'll probably see why some of us moved to Hong Kong in the first place. So on that note, let's have a look at some of the options we have. Now, just as a recap then, just to summarize where we come from, it's really about keeping clean capital and keeping that separate from income and gains. That's really, really crucial. Because if we don't, you mix them, then you can start paying tax up to 45% on your remittals into the UK. Now, you cannot unmix that fund. Once you're in the UK, and remember, you can be a tax resident in the UK dating back to the 6th of April of last year, you cannot unmix that fund. So keeping separate bank accounts, separating your clean capital from the gains and income is essential. So there are, although, some other ways of doing and dealing with this. So let's have a look. Now, all of this really boils down to what do you do before you go to the UK? So there's some ideas here. If you've got enough cash to last for an entire period in the UK, you may not be too concerned because you just have entire clean capital paying out. And this is a typical banker type advice that we get. However, why would you want to keep all that money in cash? Remember, clean capital can only be cash. You've got an opportunity cost of investments that's been eroded by inflation and everything else. So why would you do that? You may need to supplement your clean capital. You may need to sell non-UK assets and transfer that to the UK, or part of your income to the UK, in which case there are some strategies we should be considering. So first of all, let's have a look at the capital gains tax issue. So another example, separate to the one earlier, we've now got Anne and Charlotte, who are sisters, and they both have investment portfolios, and they bought Tencent for $500,000 Hong Kong dollars in 2016. They both moved to the UK in April 2020, and that investment had done very well. As we all know, Tencent's done very well, and it's now 1.67 million when they went. After 2 years, they decided to settle there, and they want to buy apartments each. Now, they both have to use remittance basis, but they have no clean capital. They didn't plan ahead in this instance. So they decide to transfer and pay their capital gains. So, however, Tencent's dropped now. It's only worth 1.6 million 2 years later. Still a good gain. So what happens? Let's have a look at Anne first. So Anne's calculation is this. Without going into much detail, you can see there's £22,000 or roughly 200,000 Hong Kong dollars in capital gains tax. Charlotte, though, took some advice before she went. We actually sold the Tencent shares for 1.6 million, and then she bought them back the very next day. She was a non-UK resident at the time, so there's no capital gains tax. So she locked in the gains there with no tax to pay because it's all in Hong Kong. The only cost she got was stamp duty, 3,000 Hong Kong dollars compared to the 200,000 that Anne's paid. Because it's made a loss since she moved, there's no capital gains tax either. So simple structuring like that with your assets before you go can make a huge difference. Now there's another way, and it's often overlooked, is using insurance as a way. So why is this any good? Well, let's have a look at it. I mean, look, anything held personally, when you become a UK resident, it is subject to tax. income taxes on your dividends, interest and rent, and capital gains tax on anything that's realized gains. And that could just be switching of funds. So your existing portfolio, you'll sell and buy, and then that triggers a capital gains event. Now, you can place most assets into a wrapper or envelope, as it's called in the UK, and in this instance, an investment-linked insurance policy. Now, the private banks call that PPLIs. We can normally call it portfolio bonds. That's historically what's called, and we stay with the historical bit. There's advantages. Have a look. So straight away, let's reference the UK government site, all about insurance. You can look it up yourself here. There's the web address for you. And this was updated last in June 2020. Now, let's have a look. Basically, it says here, anything held inside an envelope, which is a life insurance policy, the assets in there do not trigger any of the taxes we've been talking about for the policyholder. Okay, anything else is all deferred to when the policy comes to an end, and they come to an end either when you pass away, because it's life insurance, or you fully surrender it. Up to that point, you have the privilege of gains rolling up gross free. So that's in comparison though, but if you held it in your own name, you could only reinvest 55% of the income, if you like. If you're a 45% taxpayer, in the insurance policy, you can reinvest the whole lot. And capital gains, because it could incur up to 20% in the capital gains taxes, you can again invest 100% opposed to 80% if you held them directly in your own name. This is what we call gross roll-up. Now, many assets can go in there, many currencies go in there. I don't really want to go too much detail about it at this stage, but the other question I get asked is, well, you must pay tax somewhere. What about the owner, the insurance company? Well, the Isle of Man, where these are domiciled, is actually like Hong Kong. There is no income tax, dividends or interest or capital gains. So the insurance company doesn't have any tax bills to pass down to the policyholders either. So let's have a look at existing portfolios. So you've got portfolios based with private banks or online platforms. You love them. You don't want to part company with them. Well, you can wrap those two inside a life policy, and you can maintain the relationship with your bank and your relationship with the custodians. What will happen in that event is you will end up, if it's transferred inside the insurance policy, you will end up owning an insurance policy, and the underlying assets will be identical to the portfolio. You get best of both worlds. You have full control of your investments as before, but now you get all the tax benefits, gross roll-up, that insurance policies give you. Okay, that's great. Whilst the insurance policy is running, you get all the gross roll-ups rather than paying a lot of the taxes, and many of them are hidden. But what if you want to withdraw money from the policy whilst you're in the UK to fund your income, by example? Well, here again, let's look at the government's website in the UK, and let's reference that. Now, you can take up to 5% per annum, and that's 5% of the original premium, the original investment per annum out of that policy without incurring a gain, without incurring the need to pay taxes. So for example, and you can carry that forward. So for example, if you do not take your 5% allowance in any one year, the second year you could take 10%, which is the previous year and the current year's allowances in one go. And like many clients, they may take this out, say 5-10 years before they go, in which case they could take up to 50% in that example without paying any taxes. So the question is, can you live off 5% of the value of your financial assets in the UK? And this is all modeled around the 100% of the premium. So 5% will last 20 years before it becomes 100% of the original premium. So you could take 5% per annum for 20 years without paying taxes. If you take less though, it will last longer before it equals 100% of the premium. So 4% will last 25 years, 3% 33 years. That's a significant amount of time. But remember, you must put clean capital in it to begin with. So normally these things are done before you go to the UK. Now, if you take more than 5%, well, at 5% still no tax, but the amount above 5% will start incurring some income taxes if there's no previous years to offset that against. So Now, whilst you get your capital back over the years, you do benefit all the gross roll up over the period of time, no capital gains tax to pay, no income tax on the income derived, etc. So let's have a look at some examples. Different sisters this time, Bella and Claire, live in Hong Kong. They're planning to move to the UK. 50 million each, so reasonably wealthy people. And for the example here, we're going to look at it. So 5% is the return on the investments. And they need to take down £120,000 per annum to live in the UK, which is about 1.2 million Hong Kong per annum. So scenario one, let's look at a straightforward, easy flow, nothing much is happening with their lives in the UK. So the first one is, Bella says, okay, well, I could take clean capital, that's what banks say. So I'm going to move 5 years worth of income into a clean capital account with a bank, which is £600,000. The bank also is paying the 2% per annum interest into a separate bank account to avoid mixing the capital and getting a mixed fund. And the remaining 4.4 million is just enjoying existing investments in her portfolio. She starts to remit £120,000 a year of clean capital to the UK and pays no tax because it's clean capital. After 5 years, her portfolio value has now grown to 5.6 million. Now, that includes obviously 36,000 that's been added to it. So she's made 5.65 million in total in that period of time whilst living in the UK. Claire transfers a 5 million portfolio into portfolio bond in whatever form it takes, whether it's existing portfolios or cash, it's all transferring across. She makes her withdrawal from the portfolio bond of £120,000 per annum by liquidating assets, so it's fully invested, and she only liquidates assets as and when she needs it within the 5% per annum. No taxes are due because she can draw down 250 at 5%. And because it was fully invested rather than load sitting in cash, it's now worth 5.7 million. Okay. In other words, she's got £100,000 or $1 million Hong Kong dollars more than Bella just by placing it inside a portfolio bond. Now, of course, when you spend time in any country, things that tend to happen you don't necessarily plan for, and that's why the financial plans would bring. Ask what ifs. So let's have a look at another what if here. Just so 3 years in the UK, they decide to buy apartments in London. They need to draw down 500,000 for deposits and remit it to the UK. So Bella, her situation, she's still got 240,000 left in clean capital. She's used 3 years worth already. So she can use this if she wants, but she still needs to fund her income over the next 2 years. So she still needs to remit another 260,000 in any event. And you can see there the two numbers add up to 500 conveniently for this presentation. So she decides to remit the whole 500,000 from her investment portfolio anyway, because there's hardly any difference in taxes over that period of time. But her portfolio is a mixed fund and ordering rules apply. And she has to admit £881,000 to receive 500,000 in that example. In other words, she pays 381,000, 3.8 million, nearly 4 million Hong Kong dollars in taxes to receive the money she wants to buy a flat in London. Claire, by an alternative path, has been allowed 5% per annum, which is 250, as I already said. She's only been taking 120 of that, so there's 130 of it unused every year, which she can carry forward. Now, fourth year, which is this is in the fourth year, she could take all the 130 if she wants, which is 520,000. So she can transfer that to the UK without paying any tax at all. Now, an overlooked example here is you don't have to complete a UK tax return either for the life policies. So it makes life a lot easier. So let's have a look at another scenario. They both decide to stay in the UK after their 5-year stint. Bella has used up all her clean capital, so now she needs to remit income into the UK and pay tax on it. So every year to receive 120,000, she's got to remit 190, and she pays 70,000 or 700,000 Hong Kong dollars in tax every year to receive it. Claire, she's rather enjoying herself because she's got it in the policy. She's still within the 5% allowances. In fact, she's allowed to take a lot more years ahead of herself, 32 years in this example. Now, after 7 years, as Jason was suggesting earlier, we get some other interesting things happening because Bella now has to start paying £30,000 per annum in order to continue remitting her her money into the UK. And this is obviously on top of the taxes she's now paying because she's she's no longer remitting clean capital. So far, she's paid $525,000 in income in income tax after 7 years. Claire, still sitting pretty, enjoying it, no change. Her portfolio is worth 600,000 more than Bella's now because she hasn't paid all the taxes and fees. So that's 6 million Hong Kong dollars better off after 7 years. After 12 years, again, we pick that date. Why? Because the remittance charge goes up to 60,000. So her portfolio is still struggling because all the taxes she's paying, it's now just broadly worth about the same as what it was originally, because she's paid £1 million or 10 million Hong Kong dollars in taxes in 12 years. Claire, no change. In fact, she's 1.3 million better off, call it 13 million Hong Kong dollars better off than her sister Bella. Okay. Okay, things change again. 15 years, this is where the domicile issue kicks in. Right? Bella's now, well, they're both deemed to be domiciled after 15 years. So Bella has to go to a rising basis. She can no longer continue doing remittance basis. So her entire portfolio is now subject to the wrath of the UK taxes, which is, you know, quite significant. So she's now paid 1.4 million in taxes, 14 million Hong Kong dollars in taxes so far after 15 years. It's catching up. It's almost like $1 million a year at this stage. Claire, she's also deemed domicile, but, you know, she's in insurance policy. So this one is now 1.9 million better off, nearly 20 million Hong Kong dollars better off than her sister. And they could, by the way, be having exactly the same underlying portfolios. So there is an alternative scenario, of course, and something happens. They meet a British man and settle after 6 years and marry him. And do so, they become a domicile of choice. So Bella immediately, she falls out of the remittance basis and goes into a rising basis, and she pays worldwide income and capital gains taxes. And from that point onwards, she has to pay £70,000, 700,000 Hong Kong dollars in taxes per annum to enjoy her income in the UK. Claire, no difference. So summary, UK tax is complicated and can be extortionately high if you make the mistakes. Remittance basis definitely has its advantages, but it's complicated and there's traps. Planning is essential. Insurance is a very simple and highly tax efficient solution. And it is key to take advice before you go. Now, what I will say very quickly is everybody's circumstances are different. And in reality, what I went through there was suitable for one particular circumstance. You may find it's a blend of the two for you, or just one or the other. And there's some other stuff or other solutions we haven't covered as well. This is just a taste for you. So we will reach out to you afterwards and offer some opportunities to discuss further. But are there any questions at the moment? I think we're popping at the top here. Right, okay. Right, in the absence of questions, I'll make one more point. We do work within a team of professionals. We work with lawyers, accountants, and a number of other people. So we work with visa specialists if you need help there, property people, and also we work with people who can find schooling for your children if you need that, even down to transferring your pets, moving pets to the UK if you wish. Now, Paul Farrell's raised your hand. Is there anything, do you want to ask, Paul? Can you type it in the question box? Do you have any minor points you want to say? No, I think we got my friend Jason next to me.
Two for the price of one. Does Paul have a question?
Okay, Paul, we'll follow up with you afterwards, and we'll touch base to see what your questions are. On that note, we'll finish here. We'll make this available and to all of you afterwards, so you can see the videos of it. All the best and good luck. Thank you very much.